chapter, as well as thinking about why organisations use budgets, we're going to be thinking about the steps involved in creating the numbers which go into those budgets. And we're going to be having a look at capital and revenue budgets as well as cash budgets, which could be prepared around the idea of a limiting factor. So especially our functional budget, so things like purchases of raw materials, will often be constrained by a limiting factor, and we'll be seeing how to deal with that. Note then that this topic could appear in either section A, so those 2-mark questions, or as part of one of the longer questions in section B of your exam. At the bottom of the overview diagram then, for all the production budgets, we've got the usual order of events, and we'll see more of this in the chapter, but we start with our sales budgets and work down to the ultimate position, which is working out the material purchases budget. So as well as actually what we calculate, the order of the calculations is important. So starting off by thinking about why companies prepare budgets, well, it fits into this idea of a cycle of planning and control. So businesses then will want to know what it is that they are trying to achieve, their objectives, and we talked initially about profit maximisation being an objective for many companies. But then, of course, there are different ways to achieve that objective. So the organisation will need to think about what courses of action it's got, the pros and cons of each, and then choosing the best course of action. And it will then need to think about the implementation of that choice, and that's going to be expressed in part through the budget. So we're quite a way through, or at step 5, thinking about the preparation of the budget. Later in the course then, we'll be looking at comparing our actual results with the plan. So having a look at variance analysis, and then thinking about any reasons why the plan didn't quite work out as we'd imagined. So these final 2 steps are part of the control process, but we've got budgeting as the final step in the planning process. And of course, this is a cycle, because once we've had one period, we then need to go back to the beginning and think about whether or not our objectives have changed and what would be an appropriate set of goals or an appropriate budget for the forthcoming period. So the budget itself then is a quantified plan. It's putting into numbers what it is that we want to happen. So it's what we're trying to achieve, and that's compared to a forecast, which is what we think might be achieved. And through those 7 stages then of the planning and control cycle, we're trying to fulfill 5 different objectives. And you can remember those using PRIME. So we're trying to plan. Setting budgets forces management to think about what it is that they are trying to achieve. It also encourages responsibility, so looking at who can control the elements. And also it enables us to hope for integration and coordination between our departments. It's no good the production department planning to make 1,000 units a month if the sales department have based their plans on selling 5,000 units per month. Depending on how difficult the budget is, it will affect motivation, especially if employees receive rewards which are linked to targets. And that brings us into the final objective, which is evaluation and control, which is where we're comparing what we wanted to achieve with actual performance. We also need to think about something called responsibility. So the second objective then for the planning and control cycle was responsibility. And if a manager then is going to be responsible for the performance, then they need to have information about the performance. And businesses will be split up then into different types of responsibility centres, and what they're responsible for will vary. So in a cost centre then, for example, service centre, the manager will be responsible for controlling and keeping costs down as low as possible while maintaining the level of service. In a profit centre, managers are responsible for the costs, but also for driving and maximising revenues so that they can maximise profitability. The final type of responsibility centre is that of an investment centre. Here the manager has control over everything, so costs and revenues, but also investments. So it's like a mini autonomous business. At the bottom of the overview diagram then, for all the production budgets, we've got the usual order of events, and we'll see more of this in the chapter, but we start with our sales budgets and work down to the ultimate position, which is working out the material purchases budget. So as well as actually what we calculate, the order of the calculations is important. So starting off by thinking about why companies prepare budgets, well, it fits into this idea of a cycle of planning and control. So businesses then will want to know what it is that they are trying to achieve, their objectives, and we talked initially about profit maximisation being an objective for many companies. But then, of course, there are different ways to achieve that objective. So the organisation will need to think about what courses of action it's got, the pros and cons of each, and then choosing the best course of action. And it will then need to think about the implementation of that choice, and that's going to be expressed in part through the budget. So we're quite a way through, or at step 5, thinking about the preparation of the budget. Later in the course then, we'll be looking at comparing our actual results with the plan. So having a look at variance analysis, and then thinking about any reasons why the plan didn't quite work out as we'd imagined. So these final 2 steps are part of the control process, but we've got budgeting as the final step in the planning process. And of course, this is a cycle, because once we've had one period, we then need to go back to the beginning and think about whether or not our objectives have changed and what would be an appropriate set of goals or an appropriate budget for the forthcoming period. So the budget itself then is a quantified plan. It's putting into numbers what it is that we want to happen. So it's what we're trying to achieve, and that's compared to a forecast, which is what we think might be achieved. And through those 7 stages then of the planning and control cycle, we're trying to fulfill 5 different objectives. And you can remember those using PRIME. So we're trying to plan. Setting budgets forces management to think about what it is that they are trying to achieve. It also encourages responsibility, so looking at who can control the elements. And also it enables us to hope for integration and coordination between our departments. It's no good the production department planning to make 1,000 units a month if the sales department have based their plans on selling 5,000 units per month. Depending on how difficult the budget is, it will affect motivation, especially if employees receive rewards which are linked to targets. And that brings us into the final objective, which is evaluation and control, which is where we're comparing what we wanted to achieve with actual performance. We also need to think about something called responsibility. So the second objective then for the planning and control cycle was responsibility. And if a manager then is going to be responsible for the performance, then they need to have information about the performance. And businesses will be split up then into different types of responsibility centres. And what they're responsible for will vary. So in a cost centre then, for example, service centre, the manager will be responsible for controlling and keeping costs down as low as possible while maintaining the level of service. In a profit centre, managers are responsible for the costs, but also for driving and maximising revenues so that they can maximise profitability. The final type of responsibility centre is that of an investment centre. Here the manager has control over everything, so costs and revenues, but also investments. So it's like a mini autonomous business. In example 1, we're looking at one of the ways that this knowledge could be translated to a section A question by trying to think which is not a purpose of a budget. So if we're thinking then about the budgets and the planning and the control cycle, we can think about a prime. So if we're thinking about a basis of control, so we're thinking there about the evaluation and control. If we're thinking then about coordination of activities, that's going to be I. So we can see that the answer then is not going to be A or D. So we're now left with B and C. Thinking about communicating our targets to managers and formulating strategic plans. Well, if we're going to communicate to managers, we need to get them to know what their targets are, and that might be a way of motivating them. So we can use our budget as a way of saying, well, actually, guys, this is what you need to try and achieve. So it's not going to be B either. The answer is C. We can't use budgets to formulate our strategic plans. In fact, you have to know what your strategic plan is first, so that you can set a budget which will hopefully meet those objectives. When a company is preparing its budgets, then it will divide the accounting year up either into 13 4-week periods or into the 12 months. And how the budgets are prepared within the organisation will be dictated by the budget manual. This will provide information about the objectives of the budget and also the details about the procedures and the administrative procedures, and also what budgets then are the constraining ones, the main budgets. And all of this will be devised by the budget committee. So this basically is some terminology that you might need to recall. Here then we've got an overview of the budget preparation timetable. So thinking about the different steps that are involved in pulling together a master budget. So all of the things that are needed to make a master budget. And this overview of the budget timetable very much provides a signpost really for the chapter. So one of the things then that we can use the budget for is communicating to members then what the process is going to be and what the policy is going to be based upon the long-term plan. We might then need to think about what it is that is going to constrain us. So we'll be looking at the limiting factor, and we'll then, if we assume that sales are the limiting factor, we'll need to prepare the sales budget first and then the other budgets. Once budgets then have been prepared, they'll need to be negotiated with stakeholders within the organisation. So first of all then, the superiors will need to approve them until we've reached the point at which the budget committee has approved the overall budgets for the organisation. And the reason we've got negotiation here is there might be a bit of toing and froing between senior management's expectations and those lower down the organisation. We also need to undertake some review of the coordination of the budgets to make sure then that the totals align with the organisation's total budgets and that there are no inconsistencies between departments. At the end of the period then of budgeting, we'll pull it all together in this master budget, and we will then be at the end of the period conducting a budget review. So looking at the results compared to the budgets, and the main technique for this is variance analysis, which we'll see in chapter 14. The one thing to say about budgeting, it isn't something that you do once. It's very much a continuous and dynamic process within the organisation. In fact, some large companies will actually have teams that are dedicated to the budgeting process. So what does the master project comprise? Well, it's going to be a budgeted income statement, a statement of financial position, and a cash budget, all of which together will give you the overall picture of the planned performance for the budget period. And you could, for example, be asked a question in section A about what the master budget comprises. That is because in this exam, you're never going to be asked to produce the three statements in full. It's more that you need an overview of the process. However, you could be asked about one particular number, which is why we're going to work through some of the different types of budgets. And a starting point for preparing the budgets for the functions or the different departments is the limiting budget factor or the principal budget factor. So this is the thing then which prevents the organisation from expanding beyond a certain point. For many organisations then that will be sales demand. They don't make any more because they're unable to sell any more. But it might not be sales demand. There could be other factors. So there might be a limited supply of one of the raw materials or the labour needed for production. We might find that we don't have enough capacity on our machines to make any more, or we don't have enough money to invest in resources. So perhaps to invest in inventory or invest in that time lag between when goods are sold and the cash being received. There might also be issues with distribution and selling resources, so setting up enough outlets, setting up enough shops to sell the products. In lecture example 2 then, we're thinking about a limiting resource here. And so for the first 3 months of the year, only 54,600 kilograms of material are available. And we need to think about how many units we can produce per month. So we've got 54,600 and each unit uses 3.5 kilograms of material. So the maximum we can produce is 15,600 units per month. This is one when reading the question is very important, because obviously the answer would have been very different if it had said what's the maximum that could be produced during the quarter, during the 3 months. So remember with the section A questions to take care to read the requirement carefully and not to throw away marks for silly mistakes through reading the question incorrectly. As I said then, you might have to prepare a budget, and the first step would be to identify any budget factor. So in the case of example 2, we saw the maximum we could produce was 15,600 per month. And that would then have to be the maximum production units. However, if we don't have a limiting factor, we're going to start off with sales because that will be the maximum units we can sell. So we start with our sales budget and we think then about how many units we're going to need to produce. Now the sales budget would be the same as the production budget if there weren't any inventories of finished goods. But if there are, any opening inventory will reduce the number of units that we need to produce. Because if we want to sell 10 and we've already got 2, we'd only need to make 8. But we need to remember to add on any that we want to have left in closing inventory for the next period. And we might also have to think about losses that are occurring, perhaps a number of units which are spoilt in storage. So now we know how many units we have to produce, we can think about how much labour we're going to need and the amount of overheads that we're going to require. We can also think about how much raw materials we're going to need to use. So we'll need to take our production number of units multiplied by the number of kilograms or litres per unit. And we'll get that information from the cost card. Before we can think about how many units of materials we need to purchase, again we need to think about inventory, but this time it's inventory of raw materials rather than finished goods. So we can think about how much we need for production, again take off what we already have in stock and add on what we want to have at the end of the period. And again we might need to consider any losses or discounts when we're working out the value of those materials to purchase. This is all much easier to see with some numbers, and over the page now we're going to have a look at a worked example which shows the process. Because remember, you're not going to need to do the entire process as one question, but you could be required to work out one of the numbers. In worked example 1, the principal budget factor, remember the thing that's constraining us, is sales. So we're given information then about forecast sales for the 3 different types of cakes: the sponge cakes, the jam cakes and the cream cakes. And that will be the starting point then for all of our budgets. We're also given information about the materials needed and the labour needed to manufacture each type of cake. And we're given inventory levels. Now remember, there are 2 types of inventories. There are inventories of the completed batches, so the finished goods, and also the raw materials. What we don't know then is the level of closing inventory, and so we're going to have to work that out based on these assumptions we've been given. So management want to have sufficient inventory of finished goods for 10% of demand. So for example, for the sponge cakes we want to have 240 in closing inventory. And they also want to have closing inventory to cope with next period's demand equal to 20%. So 20% then of the flour needed for next year's sales. And what we have to do then is complete the functional budgets. So we start off with the sales budget, multiply that by the selling price per batch, and that's going to give us the total budgeted revenue of 1.44 million. For the production budget, we start off with the sales figure, which for sponges is 2,400, and we need to add on the closing inventory, which remember is 10% of this year's sales, because its anticipated sales will stay the same. So that would mean that we needed to manufacture 2,640, but we already have 480 batches in stock, so we take off opening inventory, and that means that we need to make 2,160. You repeat the same calculation with the other products, and what we now need to think about then is material usage. So to work out the material usage, we need to take the production and multiply that by the usage. So for example, for the sponges, we're making 2,160 sponges, and each one takes 5 kilograms of flour. So that's going to be equal to the 10,800 kilograms of flour. For the jam cakes, 4,800 cakes, each one uses 6 kilograms of flour. Remember, this is per batch rather than per cake, and that gives us 28,800. And finally, for the cream cakes, we're making 1,080 of those, and each one uses 7 kilograms of material. So that's 7,560. So in total for the production, we need 47,160 kilograms of flour, but that's not how much we need to buy, because we need to consider inventory. So we're told then that we had 1,000 kilograms of opening inventory, so we take that off, but we need to work out our closing inventory, and you can see the working has been done here. So we want to have enough flour for 20% of next year's sales. So we don't need to work out 20% of what we need for production, we need for 20% for next year's sales. So next year, planning to sell 2,400 sponge cakes at 5 kilograms each. We want 20% of that. As well as having our budget then for materials in kilograms, we also need to have it in dollars, so we can attribute a financial value to it and work out how much it's going to be needed to be tied up in raw materials. So we need to multiply that by the cost per kilogram, and we're told then that flour costs 50 cents per kilogram, which is why all those dollar values are half the kilograms. What we've just done then, or what I've worked you through for flour, you also need to do for milk. So you need to think about how much milk is going to be needed for each of those production values, and multiply it by the number of litres. So 4 litres for a sponge, 5 for jam, and 6 for cream. And then you need to take the value of 39,120 for production and make the adjustments for inventory, and value that milk at 70 cents a litre. For labour utilisation, we can't store labour, so we don't have any opening and closing. We need to look at our production figures, remember, not sales, multiplied by the time per type of labour. So we've got 2 types of labour, mixers and cooks. So for sponge cakes, the number of sponges at half an hour each is going to give us the number of hours for mixing. For jam, it's 3/4 of an hour, and for cream cakes, it's an hour. Once we've worked out the total number of hours, we then need to multiply that by the labour rate, which is $2 for mixers and 3 for cooks, to give us the total labour cost. As well as knowing how many units we're going to produce based on sales, This is really useful because we can think about making sure we've got enough resources in terms of production staff, so mixers and cooks here, and also thinking about making sure we can order in enough materials. Example 3 sees a typical exam question from section A. So we want to know then how much we've got to buy in terms of raw materials in the next month for production. So what we need to start off then is looking at our sales. Sales then are planned to be 850 units, but we're not necessarily going to be making the 850 because of these inventory figures. So at the moment we've got 100 units of opening inventory, which would reduce the amount that we needed to make. However, we want to have some closing inventory, and the amount of closing inventory that we want is going to be higher because it's going to go up to 150. So from that then we need 900 units, and those 900 units would be what we need to produce. However, in this particular scenario, we need to make more than 900 units because actually 10% of what we make is going to be discarded because it's not fit for sale, it's defective. What that therefore means then is that those 900 units are going to represent the good output, which will be 90%. Let's have a think about that now. So in terms then of total production, we're going to make 100% of the units. 10% of what we make is defective, or goes in the bin. So that means that 90% of what we make must be good output. And I've drawn up those percentages and that diagram here because in my experience, students will often start to make a mistake when they are thinking about how many units to produce. But if you remember that these good units represent 90% of production, then actual production needed will be 100%. So what we need to do then is consider the number of units that we actually need to produce. So the number of units that we're going to produce, if we multiply that by 90% or 0.9, that will give us 900 units. So therefore we need to produce 900 divided by 0.9. So we need to actually produce 1,000 units. Now that we've worked out the number of units to produce, we need to work out how many materials to purchase. There are no inventories, so we just need to multiply the number of units that we're going to produce by the 5 kilograms per material per unit. So we're going to need to buy 5,000 kilograms of materials. The next area to consider is the categorization of expenditure. So whether it is capital expenditure or whether it's revenue expenditure. Revenue expenditure, first of all, then, is the sort of things that we've been considering so far when we've been purchasing materials, because these are bought for the purpose of the trade or the business and to maintain the earning capacity. So if you've got machinery, you need to purchase raw materials in order to produce output. Capital expenditure then is the acquisition or the buying of non-current assets. So perhaps buying a piece of new machinery for your production line or some kind of improvement in their earning capacity. So perhaps adding some extra features to your machines. These non-current assets then are not sold on, they're actually kept by the business and they're used to earn the profits. And that's one of the contrasts with revenue expenditure. Then you buy things like raw materials in order to sell them on to generate sales. Something which we need to be able to do for the exam then is to categorise types of expenditure. And it's important when you are categorising them that you apply to the scenario, because what is revenue expenditure in one business might be capital expenditure in another. So in example 4 then, Brum Brum is a second-hand car dealer, and the bookkeeper then has come up with a list of items of expenditure and needs help deciding whether they're capital or revenue. So have a think then, pause the recording and have a think about what classifications you would use for each of those items, and resume it when you're ready. So if we're buying then envelopes for the office, those envelopes are not going to have any long-term benefit, and so that will be classified as revenue expenditure. However, extending the sales office will hopefully improve sales, and that will be an improvement to a non-current asset. So that extension is a capital expenditure. We're also asked to consider purchasing a new delivery van. It's assumed then that the delivery van will be kept and not sold on, and so that will be capital expenditure because we're going to use it typically for more than 1 year would be the test we would use. The road tax and the insurance for the van, although the van is capital expenditure, those running costs are revenue expenditure. They don't actually enhance the value of the van, they're just expenses that we need to incur in order to be able to use the van. Purchases then of new cars, 10 new cars. For most businesses, buying cars would be capital expenditure, but because Brum Brum is a car dealer, these are stock. So it's purchasing inventories for resale in the normal trade of the business, so that will be revenue expenditure. Repairing a broken window in the workshop, although the broken window is in one of the non-current assets, this will be classified as revenue expenditure because we're not enhancing it, we're just maintaining it, keeping it at its current value. And 5 new laptops for the salesman. Previously they'd recorded leads in a notebook, and we're not in the business of selling computers, so that's going to be capital expenditure. So the capital expenditure then will not be charged as an expense in the income of the business statement. However, the expense will be the depreciation charge, which is used to match the benefits with the expenditure. And as I'm sure you know, depreciation is an expense, so it's debited to the income statement. When we buy a new non-current asset, say some machinery or something for continuing use, that's going to be debited to the statement of financial position, which will then show that non-current asset. Revenue expenditure then gets debited to the income statement for the period in which the sales are made. So remember that matching concept there. For businesses then, this is important because otherwise the incorrect levels of profit might be reported. And we'll have a look at the impacts that making an error could have on your profits in the next example. In example 5 then, Hawk has made a mistake and a purchase of new machinery has been treated as revenue expenditure. That's incorrect, obviously, because it should have been treated as capital expenditure. We're being asked to consider then the impact that this is going to have on the financial statements. So what we should have done then is we should have debited the non-current asset account with the purchase of this machinery. We haven't done that, so what that means then is that the value of the asset is going to be too low. What we have done then is put all of that charge through the income statement, when in actual fact it should have just been 1 year's depreciation. So what that means then is that the profit will be too low and the value of the machinery will also be too low. So the correct answer here is D. We've talked about expenditure, so let's just think for a moment about income. Capital income then is if you sell one of your non-trading assets, so an investment or a piece of machinery, the delivery van, something like that. Any profits or losses on disposal will be taken to the income statement in the year in which the sale takes place. Revenue income then is much more common, and that's what happens when we sell the goods that we have manufactured or the goods that we've purchased for resale, so the trading assets. Revenue income as well would also include any income that came from any investments held by the business. One further point then is in a small business, if capital is coming from the owners, this is a transaction which is shown solely in the statement of financial position. It doesn't come into the income statement at all. Items then of capital expenditure will often be very expensive for the business, and they will be making a decision then about whether or not they've got the money available and whether or not it's a good idea to purchase those items. So planning then for capital expenditure is going to form part of the business's longer term plans, and so they'll be drawing up budgets which will include a capital expenditure budget. And we'll have a look in chapter 11 about how to decide whether or not this expenditure should be made when we look at project appraisal. You could liken this then to personal expenditure. Buying a new car, buying a new house are the sort of decisions that as a household you're likely to plan, forecast and appraise. Whereas buying some milk, buying some bread, revenue expenditure, much smaller sums of money and much more routine. The final type of budget we need to look at preparing then is that of a cash budget. Cash is absolutely critical for businesses. Cash in some respects is deemed to be king because many businesses that go bust or don't survive their early days do so because they run out of cash rather than because they weren't profitable. So it's absolutely essential for a business to manage its profitability so that in the long term it's successful, but in the short term making sure that you don't run out of money so that you can pay your suppliers and you can pay your employees and continue to trade is also going to be absolutely essential. A cash budget then shows how the balance is going to change over several months. And what we have in 6.2 then is a pro forma cash budget. So you can see we've got the months across the top, all of the cash being received and all of the cash being paid out to give the net cash flow. And hopefully that's going to be positive, but occasionally it might be negative. What we need to do then is take the opening cash position, make the adjustment for this month's net cash flow, and that will give us the closing position, which becomes next month's opening position. The way then to approach these is to start off with the easy numbers. So some things then like the purchase of a non-current asset will be very straightforward, and some items will be the same every single month. So it might be that your salary is the same each month and there's no timing difference. Then we need to think about our sales receipts and our purchases. These are the items then that if you were preparing a cash budget you would be likely to have to do some workings for. In section A of the exam you might just be asked for the cash to payables figure, for example. Timing then is absolutely crucial with these payments and receipts. we need then with a cash budget to think about not when the sale has been made, but actually when the money is physically going to come into the business. So sales that are made on credit, there could be a time delay between receiving the cash and the sale. So the cash budget then looks at when the money comes in and out of the business, whereas the income statement, as I'm sure you know, is on an accruals basis, but doesn't actually show whether or not the cash has been paid. The best way to remember whether or not something would go into our cash budget is to think about whether or not it would appear on the bank statement of the company. So if we go back up to the example, here then we've got purchase of non-current assets. If you're buying a new piece of machinery for £100,000 that's going to last you 5 years, the full 100,000 is going to show in January's cash budget if you have to pay the full amount on delivery. The person you're buying it from isn't going to be concerned that it's going to last you 5 years and you're going to depreciate it and charge £20,000 per year depreciation. So with our purchase of non-current assets then, all of that is going to be shown in one payment. In example 6 then, we're looking at which ones should be included in a cash budget. So things then that are going to result in money, physical money, leaving the business and therefore being on the bank statement. So if you buy a new piece of machinery, the cash that you have to pay for that new machinery will be included in your cash budget. Similarly, when you pay the tax bill, that's going to result in money leaving the business. When bad debts are written off, that is going to be an expense to your income statement, but it's not going to be included in your cash budget because you don't actually have any financial impact. It's going to have an impact on your profitability and it will reduce the amount of cash you received, but you won't actually show the bad debts written off in your cash budget. Similarly, depreciation won't be included because you will have included the purchase of the delivery van. The road tax, though, you have to pay for, so that gets included, as does your payment made to a supplier. In addition to deciding whether or not things are included, we might need to calculate the cash effect. So take the number from the income statement and adjust it for the figure to go into the cash budget. So in 6.4a then, we're looking at receivables receipts. January's sales will not necessarily be equal to the cash received in January. Instead, we need to think about how much we were owed at the start of the month, how much that increased with additional sales, less how much was carried forward at the end of the period, and that is going to equate to the cash that will be received. And as I said before, you don't make any adjustment for bad debts. Purchases, same kind of idea. How much did we owe at the start? How much more have we bought? How much do we still owe at the end of the period? Therefore, that final number is going to go into the cash budget as the cash paid to suppliers. It's very important for businesses to be aware of their cash position so that they can manage any surpluses or shortages that are expected. A surplus then is a good position to be in, and you need to think about how you might invest that, something which will come later in your ACCA studies. But it's shortages that are really important. Businesses need to plan for and have contingencies to make sure they don't run out of money, because that, in the worst case, could stop them trading. What we have here then is the requirement to prepare the monthly cash forecast for quarter 2. Now this could be a requirement in section B, or in section A you might have to prepare one of the numbers from this cash flow forecast. So Kookaburra then, we're given information about budgeted sales, purchases, wages and other expenditure, other overheads, and also some capital expenditure. We're also given some additional information. So 30% then of the sales are for cash, the remaining amount are on credit, and customers pay 1 month later. So what that means then is that we will be looking at 30% being received from that month, but 70% of the prior month's sales. So for example, in April, we're going to be looking at 70% of March's sales and 30% of April's sales. Purchase is a little bit more straightforward. There's just a timing difference. They're paid for 1 month later. So the purchases that we make in March, we will be paying for in April. Wages and other overheads are paid in the current month, but included in this overheads figure is $400 for depreciation, £400 for depreciation. So we need to strip out the depreciation because that's not going to be included in a cash forecast. So if we're starting off then with the easy numbers, wages then are going to be the most straightforward number because they're going to be paid in the current month. So the wages then for April are $800, the wages for May $850, and the wages for June are also $850. For other overheads, we're just going to also pay those in the month, but we need to strip out the depreciation. So for April, it's $650, take off the $400, so that's $250. And for May, it's $675, less the $400, so that's $275. And the same for June. The capital expenditure, again, is also a figure that we can just copy down. So $3,000 in May and $1,000 in June. So with purchases, they are paid a month in arrears. So paid for after 1 month. That means in April we will be paying for March's purchases. So in April we're going to pay $1,200 to suppliers for purchases made in March. In May we're going to pay $1,300 for April's purchases, and in June we'll pay $1,500 for May's purchases. What we need to do now then is to look at our cash, and we need to look at our cash in from sales. 30% are for cash, so 30% will be received in the month. So for April, that's going to be 30% of 4,600. So we're going to have 1,380 from cash sales. Then we can do the same for May. 30% of 5,000, 1,500, and 30% of 5,350 is 1,605. For the credit sales then, they are paid for a month later. So the credit sales then for April will be March's sales of 4,250, and it will be the amount outstanding that wasn't paid for in March. So it'll be 70% of 4,250. That's 2,975. In terms then of cash received from credit sales in May, that's going to be 70% of April's, so 70% of 4,600. Finally, then in June, we're going to receive 70% of those sales made in May on credit. So that's going to be 3,500. We've now done all of the calculations. What we have to do now is the adding up. So the total then for the quarter. So start off with the total cash sales, 1,380 plus 1,500 plus 1,605 is 4,485, etc. So we can just complete the table. So the total receipts then for each month, add the cash sales to the credit sales. You can see that those are increasing each month here. And we need to also look at the total expenditure. So 2,250 for April, 5,425 for May, 3,625 for June, and overall 11,300. And we need those total payments and receipts for each month so we can work out the net cash position. So for April, that will be the 4,355 less the 2,250. So we got in 4,355 and we spent 2,250. So the cash position increased quite nicely during the month. There's an extra 2,105 in the bank account at the end. Add that to the 750 that was already there, and we've got 2,855. And that will become next month, so that will become May's opening balance. However, the net cash position is not quite so healthy in May because of the purchase of that fixed asset, that capital expenditure. So here we've got a net position of minus 705. So that's going to reduce down the amount of cash that we've got at the end of the period to 2,150. The net position for June, though, back to being positive because the expenditure on capital expenditure items wasn't as great, and so we've got net cash flow of 1,480, giving us a closing balance at the end of the period of 3,630. So we started the month with 750 and we end it with 3,630. So there's been an increase in cash of 2,880 during quarter two. At the end of that, you may have felt that there was quite a lot of number crunching there. That might be necessary, or some of the numbers might be necessary in section B, but part of this example is to see the bigger picture and how it all fits together, so that if you were asked in the exam what was the purchases figure for May, from this information you would be able to work out that number, to work out that answer. There have been two main aspects to this chapter then, chapter 9. We've been thinking about the nuts and bolts of the budgeting process and also calculations for those functional budgets, capital budgets and cash budgets. So the planning and control cycle then shows the 7 stages, of which budgeting then is one of them. And a budget is a quantified plan, setting out that you want to try and make and sell a certain number of units and what you think you're going to sell them for and what it's going to cost you. Coupled with that then is the allocation of responsibility to managers, and the amount of responsibility that managers have for different aspects will be dictated by the type of responsibility centre. Cost centres, revenue centres and profit centres are the ones that you need to be aware of in the exam. Also, we have then investment centres. We'll be seeing more about those later on. The budget then is prepared as part of quite a formal process in many organisations, and that will be overseen by the budget committee. The master budget will be the end point then, and that will pull together the budgeted income statement, the statement of financial position and the cash position, the cash budget, to give an overall projection of the likely outcome for the period. Also, we thought about the distinction between capital and revenue transactions and how important it is for those to be correctly classified. So CapEx then is when we're buying some new non-current assets or improving the ones we've already got. But revenue expenditure is the most frequent, and that's for the purpose of trade. Once we're looking at preparing budgets then, we're thinking about what it is that's going to constrain us. And we'll prepare the budgets around this limiting factor or the principal budget factor. And in the absence of anything else, such as materials or labour, the principal budget factor will be sales demand. We have to make sure then when we're preparing budgets that they are consistent and that we think about the order. And remember that diagram, we start with the sales budget and work through to production and finally to purchasing, considering opening and closing inventories of both finished goods and raw materials. Cash budgets are also very, very important because it helps us to forecast cash surpluses and shortages and think about how to deal with those. Much better for a business to be aware that they need to arrange a loan with a few months to go. They can think about strategies to deal with it rather than just running out of cash and not being able to pay suppliers or employees.